Something extraordinary just occurred in the silver market that challenges everything we thought we knew about price manipulation. This morning, we witnessed a $15 drop in just 30 minutes. Silver plummeted from $121 to $106, representing a 15% decline in half an hour. But here's what's absolutely remarkable. As I'm recording this, silver has not only recovered, but turned positive for the day, currently trading at 117. This isn't typical market behavior. What we're observing is the physical market demonstrating overwhelming strength against traditional paper-based price suppression tactics. The established system is showing serious strain in real time. I'm recording this on January 29, 2026. For those following my analysis, I share live updates and technical charts as they develop on my social media platform. That's where you'll find real-time vault flow data and technical setups that don't make it into longer video formats. If you haven't connected yet, my verified handle is OGJohnAG on both platforms. That's your authentication marker. Unfortunately, impersonator accounts appear regularly. I can't chase down every fake profile, but OGJohnAG is the verifiable protected handle. That's the one authentic identifier they can't replicate. For new viewers, I don't monetize through signals, courses, paid communities, or subscription pressure. This channel provides comprehensive market analysis, clear-minded, hype-free, independent thinking. Many find value in this approach. Your questions enhance my understanding too. Feel free to comment below with any thoughts or simply drop OGJohnAG so my team and I can identify genuine community engagement. The Shanghai Premium Anomaly. Now here's what makes this situation absolutely unprecedented. According to current Shanghai Futures Exchange data, silver is trading at 31,620 yuan per kilogram. That converts to approximately $140 per ounce. Meanwhile, COMEX shows $116 to $117. The Shanghai silver premium has reached $25 per ounce. $25. Historically, a 15% price smash in 1 hour would trigger cascading stop-loss orders and induce days or weeks of continued selling pressure. Silver's entire upward momentum could be completely derailed by a COMEX paper dump of several billion ounces worth of contracts. That was the traditional mechanism. That mechanism appears broken. Currently, physical demand for silver is so intense and sustained that historic downward price movements are being completely erased within hours, and the uptrend simply continues. Examine today's timeline. 9:15 a.m., silver at $121 per ounce. 10:29 a.m., silver at $106, $4 p.m., silver at $117. We spent 4 years trading between $20 and $30, barely moving 50 cents daily. Now we're experiencing $15 intraday swings. The volatility is absolutely extreme. The critical pattern. Here's the crucial detail you need to understand. Nearly all selling pressure this week occurred during U.S. market hours. The United States sells and dumps digital derivatives and paper contracts, while the rest of the world purchases and accumulates physical metal. That's the pattern. That's the signal. When New York markets are open, paper gets dumped. When Asian markets wake up, physical gets purchased and prices recover. The bullion banks carrying short positions of hundreds of millions of ounces are growing increasingly desperate to extract themselves from their precarious situation. They're now so desperate, they've executed 2 separate $15 raids on silver this week. 2 separate attempts. What's the result? Silver spot prices back above $117. Instead of inducing massive follow-through selling like historically occurred, silver immediately rebounds and recovers the moment COMEX paper dumping completes. Relentless Asian demand from India and China simply won't allow bullion banks to suppress silver prices sufficiently to unwind their massively underwater short positions. The Shanghai silver premium surpassing $25 per ounce signals a monetary regime shift from Western systems to Shanghai. The spread between Shanghai and LBMA COMEX silver prices growing to $5 daily is simply unsustainable. System breakdown sequence. Connect these dots, and the situation worsens for the paper system. Things have already started breaking. First, U.S. refineries experienced lockups. Refineries backed up and stopped accepting metals. The retail market began fracturing midweek as reports emerged that many local coin dealers halted metal purchases due to capital constraints and slow turnaround times. Then, sources within the retail bullion industry reported Thursday afternoon that a major government mint is shutting down silver sales within the next 24 hours. First refineries, then local coin shops, now major government mints. The entire system is fragmenting, and the genuine short squeeze hasn't even commenced yet. Let that register. We haven't reached the squeeze phase. This is merely the prelude. This is just the physical market beginning to assert dominance over paper fiction. Understanding the crash triggers. Let's discuss what triggered this morning's crash because multiple factors converged. First, excessive leverage. Traders accumulated 50x to 100x leverage in futures contracts. When initial selling started, it triggered cascading forced liquidations. Small moves became massive sell-offs as margin calls hit and positions got automatically closed, wiping trillions in paper gains. Second, profit taking. Gold has risen 160% over 2 years. Silver has climbed nearly 380%. These are parabolic moves. People are securing gains, removing capital after runs like that. Third, broader market sell-off. Microsoft dropped 11% today on disappointing cloud and AI growth numbers. Morgan Stanley removed it from their top picks list, dragging NASDAQ and S&P 500 lower, creating a risk-off cascade affecting everything. Fourth, extreme overbought conditions. Gold and silver reach their most overbought levels in history. Markets flush out weak hands when conditions get that extended. It's textbook price action. Fifth, no major catalyst, no policy announcement, no war outbreak, no central bank shock. This was pure technical unwinding and position liquidation. All those factors are genuine, all contributed. But here's the critical reframing. The fact that all 5 bearish factors hit simultaneously. Extreme leverage unwinding, profit taking, equity sell-off, overbought flush, pure technical capitulation, and silver still turned positive the same day reveals everything about underlying physical demand. The paper market deployed everything available, maximum bearish confluence, and it got completely absorbed and reversed within hours. Gold initially dumped 8.2% in 1 hour, erasing $3.1 trillion from its market cap. It then pumped 5.2% and added $1.9 trillion back. A $40 trillion asset is moving like a speculative cryptocurrency. That's how fragile the pricing mechanism has become. That's how much leverage exists in the system. That's how disconnected paper is from physical. What major banks are now saying. Speaking of disconnects, let's examine what major banks are now publicly stating. JP Morgan sees gold surging toward $8,000. Gold could continue rallying as private investors increase allocations from 3% to 4.66% of portfolios, according to JP Morgan's Nikolaos Panagirtsoglou, potentially pushing prices to $8,000–$8,500 per ounce. Gold recently hit $5,600 amid safe haven demand, central bank buying, and shifts away from long-term bonds. Check the progression. Goldman Sachs, $5,400. Deutsche Bank, $6,000 JP. Morgan, $8,500. Who bids higher? The targets keep getting revised upward because fundamentals keep strengthening and banks are finally acknowledging what the physical market has been signaling for months. We're in a new regime. The old price anchors are gone. Addressing the bearish case. Now let's address the bearish perspective directly because I won't pretend risks don't exist. We just witnessed extreme volatility, $15 intraday swings that can destroy leverage positions in minutes. If you're trading on margin, holding paper contracts, running options or futures with tight stops, this environment is a liquidation machine. Your thesis doesn't matter when margin clerks call. Your long-term conviction is irrelevant when forced selling hits. Over-leverage yourself and moves like this morning will eliminate you before you witness the recovery. JP Morgan themselves noted that while momentum may spark short-term profit-taking, we could see more violent shakeouts. The higher prices go, the more profit-taking opportunities exist. The more leverage builds, the more violent deleveraging events become. Gold shows stronger liquidity and breadth than silver or Bitcoin according to their analysis, which means silver could experience even more extreme percentage moves both upward and downward. Here's the other risk. If equity markets continue selling off, if we see broader risk-off movement, if recession fears escalate, we could see more forced selling in metals as people scramble for cash and liquidity. The correlation between metals and equities during panic moments is real. It occurred in 2008. It occurred in March 2020. It can happen again. Why the structural setup remains intact, but here's why the bearish case, while real for traders and over-leveraged positions, doesn't alter the structural setup for physical holders. Every single data point reinforces the bull case. Shanghai premium, $25 refineries locked up coin shops, halting purchases, major government mints shutting down silver sales. Two $15 raids this week, both completely absorbed and reversed. The physical market is signaling deficit, the paper market is signaling manipulation, and the physical market is winning. The fact that silver turned positive after a 15% crash the same day is unprecedented. That has never happened in this market's history. Never. The banks used to induce weeks of follow-through selling with such moves. Now they can't maintain suppression for a full trading session. Asian demand, Indian demand, Chinese demand, it's relentless. It's overwhelming the paper dumps. The Shanghai premium growing $2 to $5 daily is unsustainable. That spread must close. And it will close one of two ways. Either COMEX prices rise to meet Shanghai, or physical metal stops flowing west and the entire COMEX LBMA pricing system loses legitimacy. We're already seeing early stages with refineries backing up, coin shops halting, and mints shutting down sales. The plumbing is seizing. 3 key takeaways. Where does this leave us? 3 key takeaways. Number 1, the old playbook where COMEX could dump paper and induce weeks of selling is dead. Silver crashed $15 in 30 minutes and turned positive the same day. That's unprecedented. Physical demand from Asia is now powerful enough to overwhelm any paper manipulation attempt within hours. Number 2, the system is breaking in sequence. First, refineries locked up, then local coin shops halted purchases. Now a major government mint is shutting down silver sales within 24 hours. This is the physical market seizing because demand is overwhelming supply, and the $25 Shanghai premium is pulling metal east faster than the West can deliver. The real squeeze hasn't even started yet. Number 3, major banks are revising targets higher in real time. Goldman $5,400, Deutsche $6,000, JP Morgan $8,500 for gold. They're acknowledging the regime change. Private investor allocation increasing from 3% to 4.6 to 6% of portfolios represents massive capital flow that's just beginning, and silver, with its smaller market and industrial deficit, is leveraged to that movement. The unresolved tension. The unresolved tension is this: how long can the Shanghai premium stay at $25 before the entire Western pricing system loses credibility? How many more $15 raids can the banks attempt before realizing they've lost control? What happens to price when the physical squeeze we're seeing in the plumbing actually hits derivative markets and forces mass short covering? We're living through the transition from paper dominance to physical dominance in real time. The moves will be violent both directions. The volatility will be extreme, but the direction is established. Final guidance. Do your own due diligence. Understand the risks. If you're trading on leverage, this environment will destroy you. If you're building physical with a long-term perspective and you understand what's happening structurally, this might just be the shakeout before the real move begins. Invest with logic, not hype.